straight into this, John, if it's okay. Just first of all, tell us a bit about yourself, and then if we can get into the meat of the subject with your slides, that'd be great. Thank you.
Thank you, Terry. Can I just check before I get started? If I'm starting now at 11 minutes past 3, am I finishing at 11 minutes past 4?
It would be 4 o'clock. I need to. Can I ask our viewers, are you okay to run on for till 10 past 11 minutes past 4? You could put in your. Yeah, I think if you can, you're going to have to see some of this down, I think, John.
Yeah, that's fine. That's fine. So briefly, my name's John Helps. I'm a chartered accountant. I have been for over 30 years. I'm the honorary treasurer for SAFE, and I've been a self-employed accountant with my own practice for about 18 years, and I deal with a whole variety of more or less owner-managed businesses. Just a brief small print. Just don't rely on everything I say this afternoon without checking it with your own particular circumstances. Obviously, lots of different circumstances, lots of different conditions, and it's really important that you make sure that your circumstances and your conditions match the actions that you're taking. So what I'm saying, I believe, is right, but just check with your own circumstances before you rely on me too much. This afternoon we're going to talk about automatic enrolment, a bit of succession planning, a bit of VAT, and a bit of income tax. The bulk of this is going to be on pension, because that's probably one of the biggest things that's happened to small businesses, employers in general, in recent months. It pretty much applies to all employers. Under the Pensions Act 2008, every employer in the UK must put certain staff into a pension scheme and contribute towards that pension scheme. This is what's called automatic enrolment. And an employer is basically anyone who employs at least one person. So if you employ at least one person, you're an employer. You've then got these legal duties concerning automatic enrolment. If you fail to comply with the duties, the pensions regulator can get quite upset and take enforcement action or issue a notice or a penalty against you. And the key thing to understand when you're dealing with automatic enrolment is to understand exactly when it is that it comes in for you. It's not the same date for everybody in the country. Some businesses started last year. Some businesses won't start until next year. Some businesses are starting now. You start from what's called your staging date, and your staging date has already been determined. You probably know what it is. If you don't know what it is, you would have first been told it in a letter from the pensions regulator, and you'd have had a letter that said automatic enrolment is coming. Your staging date is the 1st of August, the 1st of September, the 1st of October 2016, 17, 18. And that's the date from which you've got to comply with these new regulations. If you don't know your staging date, you don't recall having that letter, you can't remember what you've done with the letter, you know you've definitely lost the letter, then you can find your staging date by visiting the Pensions Regulator website, and it's there on the screen, pensionsregulator.gov.uk, or you can just Google Find My Staging Date. To be able to do that, you need your PAYE reference number for your payroll scheme. Once you've got your staging date, which is really the key thing to understand, because you don't know where you are until you've got that date. Once you've got that date, then you can think about the various steps that you need to go through to be ready to implement automatic enrolment. And briefly, planning, deciding, changing, informing, setting up, and so forth. So under planning, things to think about, it may be that you've already got a pension scheme, and it may be that your employees or some of your employees are already in that pension scheme, and it may be that you're perfectly happy with it. In terms of these regulations, in terms of automatic enrolment, it just depends on whether your existing pension scheme is compliant with the new rules. Not every pension scheme is. So for example, I have a pension scheme, my staff are in that pension scheme, I'm perfectly happy with that pension scheme, my staff are perfectly happy with that pension scheme, but that pension scheme is not compliant with the new rules. So I've had to make some new arrangements under automatic enrolment that are separate from the scheme I've already got. So if you're not using your existing scheme, what scheme are you going to use? If you haven't got a scheme already, what scheme are you going to use? And you can delay the actual starting of your pension scheme by up to 3 months from your staging date. You have to tell the pensions regulator if that's what you're going to do. So you need to just plan these various aspects of it. You might also want to talk to your payroll supplier just to make sure that the software you're using integrates properly with your chosen pension scheme provider. You want to talk to your accountant perhaps, you want to talk to an independent financial advisor to give you advice on what is the best scheme for you. You need to get these things in place fairly early on. Certainly 6 months before your staging date, you need to have thought about some of these items. You need to decide what pension scheme you're going to use. Nobody's going to tell you which pension scheme you have to use. You have to make that decision for yourself. And you can use one of the big pension providers, Aviva, Scottish Widows, General Guardian, Royal, whatever. It doesn't matter what you want to, which pension scheme you want to use. Some of those will charge you. Some of those will only be interested if you have a certain number of staff to put into the scheme. Some of those are more suited to you than others. Some of them are better performers than others. That's something that you really need to establish. You need to also establish, once you've decided what scheme you're going to use, what contributions you're going to make. There is a minimum, but you don't have to pay just the minimum. You could pay more. You need to work out when you're going to set that up, because although the staging date is when it must be operational by, you need to have done some setting up before that. You can't set it up in 10 minutes, as it were. And you may need to decide who you're going to use to set that scheme up for you. You may not want to do that yourself. You may want to do it yourself. You may want somebody else to help you. I'd also just mention at this point that the government has set up this thing called Nest. Nest is a kind of catch-all for all the little people who haven't done anything bigger. So if you don't want to go and use one of the big pension companies, or if you are just a very small employer with just 1 or 2 members of staff, or if you just really want the easiest, simplest, but legal option with the minimum amount of effort, you might consider using Nest. You can find Nest by simply Googling it. It's the National Employment Savings Trust or something like that. Anyway, Nest. That's the pension scheme that is set up by the government to guarantee that everybody can find access to a scheme. Nobody can say, I tried the big companies, but they wouldn't have me because I was too small, because Nest is there for you. Next process in the next stage in the process, you'll want to assess your workforce. Some of your staff will need to be put into the scheme. Some of your staff will not need to be put into the scheme. Some of your staff will want to be put into the scheme. Some of your staff will want to be taken out of the scheme. You need to work out exactly what you're going to do with all of that. Throughout the process, you've got to communicate with your staff. There are standard letters that you can use. Generally, the pension providers will provide you with standard letters. Software is often set up to provide the standard letters. One way or another, you've just got to make sure that all your staff know precisely what's going on, which scheme they're being put into, why they're being put into it, what effect it will have on them financially, and so on. You've got to make sure that while you're checking things, that the data that your system is producing is compatible with the pension provider. So a lot of this is integrated. We've got use over the last couple of years of real-time information with payroll, where the payroll system talks each month end to the Inland Revenue, to HM Revenue and Customs. Sorry, showing my age there. So we're used to communicating with HM Revenue and Customs on a monthly basis. This is really an extension to that, where not only you communicate with the HMRC each month end. You're also communicating now with the pension companies each month end or each payroll run, because each time you run a payroll and you've got people in automatic enrolment, then pension contributions need to be made. And you need to tell the pension company what you're doing, and that's generally done electronically. You need to make sure that your data complies with their requirements. You need to train people. You need to make sure that you're keeping the records. You need to tell your workers, I've mentioned that already, I won't dwell on that. It's important that your workers know what's happening at all stages. You'll need to set up some kind of pension account. So you choose your pension provider, whoever it is, Aviva, Nest, Legal & General, whatever you're doing, and you set up an account with them so that it's ready when your staging date arrives. That can be quite consuming, particularly if you've got a lot of employees, and it's worth just saying, don't leave that until the day before your staging date, because you'll be too late if that's what you do. You've got to make sure that all the staff have been enrolled into your scheme who are appropriate. Not everybody has to be. Some people will be, some people won't be. You've got to make sure that you've got everybody set up. Now, I keep saying some will, some won't. You have to, and some. Here's a little table that sets out, no, this isn't the table I was thinking of, this is a different table. Contributions. This shows you what contributions you're going to have to make into the scheme. At the moment, until the 5th of April 2018, the minimum contribution you have to make is 1% as you, the employer, and 1% by your employee. From the 6th of April 2018, that goes up so that the employer's minimum is 2% and the employee's contribution is 3%. And from 6th of April 2019 onwards, that's 3% from the employer and 5% from the employee. So that 5% of a figure, or 3% or 2% or 1% of a figure is the figure that needs to be made. A contribution needs to be made to the pensions company. It's not necessarily the gross salary. It can be the gross salary. It's actually the gross salary minus the minimum amount of 5,000 5,000-ish pounds. I'll give you the actual figure in a moment. So if somebody's on £20,000 a year, take off £5,000, £15,000 a year. 1% of £15,000 is £150 per year, paid on a monthly basis. So this is the table I was trying to mention just a few seconds ago, when we're trying to distinguish between three groups of members of staff. We've got eligible members, entitled members, and non-eligible members. But it's easier to see in this table. This is what I was thinking of just now. And the figure £4,000 that £5,000 that I'm not giving you properly is 486 times 12. It's £5,832. Now, you've got to categorise your staff into three age groups: 16 to 21, 22 to the state pension age to age 74. And you've also got to categorise your staff into the amounts that they earn, 486 and below, between 486 and 833, and over 833 pounds. And that's per month. The figures on the right hand side are per week. 486 pounds a month. Somebody who earns less than 486 pounds a month doesn't have to be put into a pension scheme. There's no compulsion. They can join, they can ask. Between 486 and 833 pounds, again, no compulsion to put them in, but again, they can ask. The difference between those two categories is that in the case of the 486 pounds and below, you don't have to make a contribution for them. Between £486 and £833, if they choose to join, you must make a contribution for them. And then anybody over £833, they are either eligible to join, they have the right to join, or they must be enrolled. So the only people who absolutely must be enrolled in this are people who earn over £833 a month, £10,000 a year, who are aged between 22 and the state pension age. They must be enrolled. There's nothing to, they can't avoid it. They must be enrolled. Anyone else can join, but is not compulsorily in the scheme. So if you're aged between 22 and the state pension age, you're going into this scheme. And this is something that people sometimes misunderstand, and this is important. People have got hold of the concept of opting out. Opting out is something that someone can do once they've been put into the scheme. But you can't opt out of the scheme altogether. That is to say, you, the employer, can't turn around to the pensions regulator and say, well, I've spoken to my staff, they all want to opt out, so we're not doing this because nobody wants to join. You can only opt out of something that exists. So if you've got members of staff aged between 22 and the state pension age, earning over £833 a month, you must set up a scheme, and then they can opt out of it. But you must set the scheme up, they must be put into it, they have no choice. They can then, once they're in it, then they can choose to leave it, but they can't choose to just ignore it, and nor can you as the employer. Let's just skip that slide for a second. So opting out, I've mentioned a little bit about opting out. Once you've set up a scheme, once you've put your members of staff in the scheme, you can then, they can then choose to opt out of the scheme. That is to say, they simply say, I don't want to be part of this pension scheme. I don't want to give 1%, 2%, 5% of my salary to a pension scheme. I just want to take my money and go home. They can do that, and they can opt out. You can't encourage them, force them, bribe them, persuade them, or anything else to do that. That would be illegal, and you can get yourself into trouble with fines and penalties for doing that. Once you set the scheme up on your staging date, they've got 1 month to opt out, and in that 1 month, any contributions that you've paid on their behalf get refunded to them. But if they opt out after that 1 month, then they're going to, they can opt out, but the contributions that they may have paid will stick. They won't get those contributions back, and they'll have to wait until they retire to get the benefit of the very tiny pension that they will have built up while they were contributing. So you can't force someone to opt out. Someone who is automatically enrolled can opt out. If we go back to that earlier slide, it's only the people who must be enrolled who can opt out, because nobody else has been forced in. They're all opting in or have a right to join. It's only the must be enrolled people, 22 to state pension age, over £833. They are the only people who are forced into the scheme. They are the only people who can opt out. Having said that, it's entirely possible for someone to decide they want to opt in, someone who's not automatically being put into the scheme. They can opt into it, and they can subsequently change their mind and opt back out of it. But again, because they're not opted out within 1 month of being forced in, they're not going to get their contributions back. Right, what's next? It's worth just saying that processing pensions really does form part of the payroll process. So if you're using something like Sage as your payroll software, Sage has been designed to talk to a variety of pension companies. It's automatically linked to them so that as you run the payroll, the pensions processing is part of the payroll process. When pay slips are prepared, you get a summary of the contributions. The software itself talks to the pension company in much the same way that the software you're using now is talking to HMRC for RTI purposes. And it's important to understand that, really, because whether you're using software in-house and you've got an in-house payroll processor, whether you're using your accountant to run your payroll for you, whether you're using a third party to run your payroll for you. You can't really have this done in two separate stages, or not efficiently. You can't have it done in two separate stages. You really want the payroll and the pension processing to be done in the same place. Otherwise, you're going to have two stabs at the same piece of information. That's not going to be efficient at all. Once you've got everything set up, you need to complete what's called a declaration of compliance. Declaration of compliance must be completed within 5 months of the staging date, and it just lets the pensions regulator know that you have done all the things that you're supposed to have done. And you'll see from this, we've got a staging date, we've got a declaration of compliance 5 months later. You'll see from this, and you'll see from it even more when you're dealing with the pension company, that there are a number of deadlines, and you just can't miss these deadlines. You can't miss the staging date deadline, you can't miss the declaration of compliance deadline, nor can you miss the payment deadlines that the pension companies set up for you. So if you deducted 1% of a salary from a member of staff, you have a set date by which that must be paid to the pension company. If you don't hand it over to the pension company, then it's broadly treated as theft, because you've taken something off a member of staff with them believing that's going to a pension fund, and it hasn't gone to a pension fund because you're late paying it, you've held on to it. If you're holding on to something that's not yours, that's generally considered to be theft, and people get very upset by that, and you can have penalties. It's just worth saying on the penalty side of things that penalties can run, where's my piece of paper? Penalties can run to as much as £10,000 per day. Now, you have to have a big pension scheme to be running at £10,000 a day. They start at £400. They can build up to a large daily penalty. It's just important that you get automatic enrolment right. Some of the things that crop up from time to time, and I haven't got a slide for this, but it's worth saying. One of the things about automatic enrolment that people say is, well, I've got a pension scheme. So I have a pension scheme. As I said, I've got a pension scheme. My staff are in it. It's not compliant with the new regulations. So I had a choice. I could either get rid of that pension scheme and go and get an entirely new pension scheme that was compliant, transfer all my staff into that, and run the new pension scheme. Or, because I'm just a small employer that wants an easy option, what I've done is I've kept the non-compliant pension scheme. Still pay into that non-compliant pension scheme. I'm happy with it. The staff are happy with it. It works for us. We've got that pension scheme. We've then gone to Nest, this kind of catch-all, easy peasy pension scheme for small businesses, and we've set up a pension scheme there as well, and that pension scheme is compliant with the new rules, and the relevant staff have been put into that pension scheme, and the staff have actually, of their own volition, turned around and said, we'd like to opt out of that pension scheme, and that's fine. I've complied with the law. I've set up a pension scheme. It's a compliant pension scheme. It meets all the requirements of the law. I've put the staff into the pension scheme. That's absolutely fine. If they've earned enough to go into the scheme, if they're the right age, I've put them into the scheme. They have then turned around and said, we want to opt out of the scheme because we've got this perfectly good pension scheme over here, paying, doing exactly what we want. They've opted out. And it will stay that way for 3 years. And in 3 years' time, the way automatic enrolment works, all the staff who've opted out will be opted back in automatically. We'll have to do a new process. They'll opt back in. They'll be put back in. They'll be automatically enrolled back in. If they want to opt out again, they can. We'll have to do a new declaration of compliance. The whole process is repeated every 3 years, just to make sure that anybody who opts out of this system is opted back in. The government is very keen that we have our own pension schemes. The state pension is creaking at the seams and is not going to cope with everybody and keep them in the style to which they've become accustomed. So we really need our own pension schemes. The government's very keen on it, and it will just automatically re-enroll anybody who opts out. That's automatic enrolment. I haven't seen any questions come up. If we have questions, I'm more than happy to take them, and you can type them in the little box at the bottom left-hand corner of your screen, and I will deal with them. If you think I've missed something important out, let me know. If I've muddled the waters and made it more confusing than it was, let me know. If you don't have any questions, I shall move on. If you haven't thought of the question already, we can deal with the question at the end. Okay. If you want to come back to automatic enrolment, just give a shout at any time. Next topic, succession planning. I read something in a professional magazine. Only about 2/3 of UK family businesses have actually thought about succession planning or have succession planning in place. You may have a successful business. Your children, your staff may not want to take that over when you retire. How are you going to get value out of your business so that the value that you've built up in your business, what are you going to do with it when you give up and you want somebody to take over? How are you going to push the business from your generation or from you to someone else? How is that going to work? In my own case, none of my children want to be accountants. They consider it far too dull and far too much like hard work. So none of them are interested in taking over Skingle Helps & Co. So it's not going to be Skingle Helps & Co. and son or daughter, because I've got to find somebody else. Now, how am I going to do that? What am I going to do about it? I've been involved in a couple of, more than a couple, I'm involved in a couple this year, but over the years I've been involved in several business sales, and a clear picture has really emerged from those sales. Often people leave it too late. They take the opportunity of an out of the blue offer. They think, oh great, I've just been offered a lot of money for my business, I'll go with this offer, and they haven't really planned it or thought about it. They just take the offer when it comes along. But actually it can take quite a long time to get a business ready for sale. One of the biggest embarrassments of my professional life was a client who I recognize the name of, but you won't, and it's not even a funeral director, so I'm probably on safe ground here. But the director wanted to sell his company. He found a buyer. We went along to a meeting, and it was a very difficult meeting when the buyer queried profitability and certain expenses, and the seller rather sheepishly admitted that the accounts contained what he called lifestyle expenses. And by lifestyle expenses, what we basically mean is a large boat, so that the significant motor expenses were not basically motor expenses. This came as a great shock to all concerned, especially me, and also the purchaser. And the purchaser simply said, you know what, I don't trust your accounts, I'm not interested. And the deal was lost, and it just happened. Just while I'm still on that, it's important to get your business straight. We all know when we run our businesses that there are things that could be better. When I look at my business, I realize that there are aspects of my business that could be better. And if I wanted to sell it, I would have to have sorted them out first. These are the sorts of things that we're talking about here. And when you've got some members of staff, you want to think about whether their staff contracts are okay, whether their employment contracts are right, whether health and safety is okay, whether from an accounting point of view you want to check your sales ledger to check that any bad debts have been properly written off, your purchase ledger to make sure that that's straight. If you're a funeral director, you want to make sure that the number of funerals that you are telling your potential purchaser actually reconcile to the figure that's in your account. It's no good saying I do 550 funerals a year and that's not reflected in £1.2 million worth of turnover. It's got to tie up, it's got to reconcile. And when you come to due diligence and The purchaser's accountants are poring all over your accounts and looking into all the aspects of your business and your health and safety and your staff contracts and so forth. It's a little bit late in the day to discover that you have missed some enormous aspect of staff employment, or your accounts have got a huge hole in them, or that you have no idea who owes you money, or that you haven't properly collected your debts. This takes time to get straight. If we all started getting our businesses straight today, we might all have them ready in time by the time we come around to selling them, but it takes time. Something to think about. When it comes to selling a business, a lot of you will operate through limited companies. Some of you will operate through limited companies. Some of you will be sole traders or partnerships. It's important to understand what it is you're selling and what the tax is that arises as a result. For example, suppose we've got a limited company which has a business within it. That limited company could sell the business, in which case it, the limited company, would make the profit, and it, the limited company, would pay tax on the disposal of that business. Or you, the shareholders of that limited company, could sell your shares. And it's the difference between paying income tax and paying capital gains tax. And when it comes to personal income tax, we're looking at rates of between 0 and 50%. When it comes to capital gains tax, we're looking at rates of between 0 and 20%. So capital gains tax can be a really significant saver. I've got a slide here, if I can just find it over here on the right-hand side. I can't, yes I can. Sorry boys and girls. Here we are. I dealt with a client who had a limited company that owned a property. A developer approached them and said, we'd like to buy your property. And there were two options. Either the company could sell the property to the developer and then the shareholders of the company could extract the money, or the shareholders could sell the company with the property in it. In the case here of the sale of the property by the company, the figures worked out that the company would make a profit of £800,000. The tax would be about £180,000. So the company would then be able to pay a dividend of about £580,000. And the shareholders themselves would end up paying tax on that dividend of about £190,000. So out of the £800,000 of profit, after everybody had paid their tax, about £400,000 was left over. That's not what we did in the end, because in the end we persuaded the purchaser, the developer, to buy the company as a whole, and by selling the company including the property, the company just went with the property in it. The shareholders made a capital gain of £800,000. They were able to get entrepreneurs relief on the capital gains tax, so only paid a rate of 10% tax on that. £83,000 of tax, so the proceeds were £762,000 net of all tax, saving of £364,000. If you can sell the company with the property in it, that's great, but the purchaser has got to want to buy the company. The purchaser typically just wants that property. He doesn't want the company with all the skeletons in the cupboard that the company might have. So it was important in this case to make sure that the company was clean, there were no skeletons in the cupboard, and that whether the developer bought the company including the property or whether he just bought the property on its own, he wasn't disadvantaged by inheriting a whole mass of problems with the limited company. And that was something that worked. There was a saving of over £360,000. But again, it's something that takes a little planning to get right. Something else that needs to be got right. Some people will be aware that you can get a company to repurchase its own shares, and this can often work quite well in a succession planning sort of way. It may be that you've got some shares, your spouse has got some shares, and your children have got some shares, and you want basically to sell your shares to your children. Doesn't have to be children, could be staff. I'm just using a family situation, but it could easily be bosses and their staff. And if the staff have got some shares, but they can't afford to buy your shares, so here we've got a situation where shareholder A has got 10 shares and shareholders B and C, who've got 45% of the shares each, want to get out, but shareholder A basically can't afford to buy shareholder B's shares, can't afford to buy shareholder C's shares, then what you could do is simply get the company to buy back B and C's shares. So that instead of having 100 shares of which shareholder A has got 10 shares, 10%, we've now only got 10 shares left in the company. Shareholder A has got 10 shares and he is now a 100% shareholder. Shareholders B and C get their money from the company. The company might be able to borrow that money before it uses it to pay these shareholders. But it's an easy way of getting rid of shareholders, getting out of the company in which they own a significant proportion. However, again, because this is a quite technical legal process, you can't just say, oh, here's £100,000, now I've got your shares. This is a legal process that requires proper documentation and proper legal work. And it can go horribly wrong when you come to sell a company that has previously repurchased some of its own shares, but done it improperly, because a purchaser might very well simply say, if you've not repurchased those shares properly, how do I know that you've purchased them back at all? How do I know that those other shareholders aren't going to come and claim part of my company? I do not want to buy your company. And in fact, I've known that in the case of a potential sale, where the potential purchaser simply turned around and said, I'm not satisfied with your documentation regarding the repurchase of your own shares. I'm not going to buy your company. I will buy your business from the company, but then going back to that earlier slide, the tax was just way, way more expensive. So there's a couple of things to think about on succession planning. First point to make, that it's important that you do plan. It's important that you give yourself enough time to turn your company that may be a little bit rusty in places, maybe a bit shambolic in certain areas. I'm talking here about my business, not yours. I'm not being rude about you, I'm being rude about me. When I look at my business, there are so many things that I would want to get right before I could persuade somebody to buy it, that I really need to be thinking before now in anticipation of a few years' time to get those things right. The other significant area where I have seen it go horribly wrong is when you've worked out where you want to sell a business, but you've not got the paperwork right. Repurchase of own shares and the paperwork is wrong. It will prevent potentially you selling that company. And I really would urge you to make sure that any paperwork you've got in connection with anything that you're doing with your business is not going to let you down when it comes to selling the business, and you will regret the time that you didn't spend a little longer just sorting your business out. Again, that's the end of a section, because I'm going to move on to VAT. And again, if any of you have got any questions at that point about succession planning or any of those items that I just mentioned, I'll answer those questions now if you'd like to type in the bottom left-hand corner. And similarly, if you've thought of something on automatic enrollment, I'll happily deal with that now as well. Otherwise, I'm going to move on to VAT. I'll keep going, and if a question appears in the little box in the bottom left-hand corner, I'll take the question and deal with it. We'll do them. VAT. I'm working on the assumption that as members of SAFE, I'm likely to be talking to funeral directors, and that therefore you're involved in funeral directing business. But before I get that specific, let me just talk briefly about VAT. VAT is charged on goods and services that you supply to your customers. So if I'm an accountant and I bill you £100 for some work that I've done for you, I am going to charge you 20% VAT, add that to your bill, you're going to give me £120. I'll give £20 to the government, I'll keep the £100 for myself. That's broadly how VAT works. And if I buy, as a VAT registered person, if I buy something from somebody who's VAT registered and they charge me VAT, I have to give them the VAT, but I can claim that back from the government. Now, in terms of registering, not all of you will be registered, not all of you will need to be registered. You need to register for VAT if, looking back 12 months from the end of a month, you've exceeded the registration threshold. Now, the registration threshold at the moment is £83,000. So if your sales figure in the 12 months ending the 31st of August 2016, if your sales of taxable supplies in that period exceeded £83,000, you should be registered for VAT. If your taxable supplies in the 12 months ended 31st of August 2016 did not exceed £83,000, then you don't need to be VAT registered. The key thing when it comes to funeral directors is knowing what taxable supplies are, because a lot of what you do as funeral directors involves the work of the disposal of the remains of the dead. And along with a number of other things listed here on this slide, these things are exempt from VAT. Now, land and buildings, a lot of stuff to do with land and buildings, gambling, betting, lotteries, credit, education, training, charities, membership organisations, doctors, dentists, all this work is considered to be exempt from VAT. So none of those people charge VAT on those supplies. And you'll see there at the bottom, certain services from undertakers, funeral directors, are also exempt supplies. So when you're looking at your turnover for the last 12 months, you're having to split your turnover between stuff on which VAT should have been charged and stuff on which VAT need not have been charged because it was exempt. And we're only interested in the taxable supplies. We're not interested in the exempt supplies. But it's important to understand what is exempt and what is standard rated. As a funeral director, if you are disposing of the remains of the dead, then you can supply a coffin, you can cover and fit a coffin, you can have a casket or urn, you can embalm, you can dig and prepare graves, you can transport the deceased to the burial ground or crematorium, you can provide a shroud or robe, a chapel of rest, you can provide bearers, transport for mourners, and so on. All those things which are essential to the disposal of the remains of the dead are exempt, so that you would not need to charge VAT on those if you were VAT registered. And if you're not VAT registered, you don't need to take the supply of the cost, the sales figure of those items into account when determining whether you've reached £83,000. However, here is a list of items. I'm sorry, it's a bit small on the screen. But there are a number of things that you provide during your work which would be standard rated or which would count towards the registration threshold. So burial of animals is not exempt. It's only burial of people that's exempt. Coffins, urns or shrouds separate to a funeral package. Flowers, wreaths, announcement cards, newspapers, hires of vehicles with a driver to someone who is not another undertaker. So you might use the cars for weddings or for other purposes, other limousine hire. Those are going to count towards the standard rated sales threshold. The hire of a hearse or limousine without a driver, even if it's part of a funeral, if you haven't provided the driver, you've only provided the car, then that is effectively a standard rated item counting towards the registration threshold. Catering, customer service satisfaction services, work on monuments at a cemetery or crematorium, and anything in commemoration with dead people, so newspaper announcements and so forth. And exhumation services that are not connected with reburial to another site. So a special form of exhumation not connected with reburial. All of those things would be treated as standard rated. And as such, when you're looking at whether you should be VAT registered or not, you need to count up those sales to see if those sales exceed £83,000. And if those sales exceed £83,000, you need to be VAT registered. A lot of funeral directors simply say, oh yeah, we're funeral directors, what we do is exempt. We don't need to think about VAT. But those particular aspects shown there on the screen are not exempt, and you do need to see if those exceed the £83,000 VAT registration threshold. It's worth just saying that zero-rated items, such as orders of service for use in a funeral commemoration service, those are actually zero-rated. Although you appear to add no VAT to the bill, you are in fact adding VAT at 0%. And I guess not too many orders of service. You have to do an awful lot of orders of service to get to £83,000, but you have to count them in the total amount. So again, VAT, the thing I want to just mention this afternoon is don't just assume that you don't need to be VAT registered, because you need to look at the standard rated and zero rated items that would be standard rated or zero rated if you were VAT registered. The items that would not be exempt, it's those items that you've got to have a look at to check whether you are supposed to be VAT registered or not. Now I have a question from Mark that says, am I right that catering, press notices, flowers do not count if they're recharged to the client as disbursements? That is correct, provided you're not making a profit on them. That is to say, if it costs you £10 to provide flowers and you charge the customer £10 for the flowers, then that is a disbursement. If you pay £10 for the flowers and you charge the customer £20 for the flowers and you make a profit, then that is not a disbursement. A disbursement is expressly something on which you make no profit. It costs you £10, you charge them £10. So, for example, we often see disbursements on the bottom of solicitors' bills. If you're buying and selling a property, there'll be fees for searches and postage and bank charges, telegraphic transfers, and so on. They simply say it was 30 quid for the telegraphic transfer. It's a bill for 30 quid. They can't add to the overall bill. In that case, you can treat them as disbursements, and in that case, they are not going to count towards your potential VAT registration threshold. If you have any other questions, keep them coming. No problem, Mark. Happy to help. Finally, a little bit on income tax, and I realise it's 4 o'clock, so I'll just go as quickly as I can. Briefly to just say that, thank you, Terry. Income tax rates over the next couple of years. We're in 2016-17 now. Personal allowance that we each have before we pay tax is £11,000. Then there's a basic rate band of £32,000, so that the higher rate kicks in at £43,000. From next year, 2017-18, those limits will be 11.5, 33.5, so that the higher rate threshold kicks in at £45,000. That's just something that often crops up in conversations with my clients. When exactly do we start paying higher rate tax? A couple of changes that have come in this year, since April this year. First one I want to mention, the personal savings allowance. It's now possible for basic rate taxpayers to receive £1,000 of savings income, interest basically, tax-free. Higher rate taxpayers, that is to say people paying 40% tax, can make £500 tax-free. Anyone earning enough that they would be an additional rate taxpayer paying 45%. This doesn't apply to them. But basic rate taxpayers, £1,000 per year interest free. Now, actually, there are very few people who are making a great deal of money on interest. And what it basically means is for a huge number of people, interest is now basically not taxable. And that's useful because I understand that if you've got a director's loan account where you have lent money to your company, if you charge your company interest on the money you have lent it, then that interest is tax deductible in the hands of your business, but is tax-free in your hands. And a number of people are using that little trick to charge their companies interest for a director's loan account, but actually not need to put that interest on their tax return. Second significant change that affects a lot of people, particularly self-employed, particularly shareholders in owner-managed businesses, is that dividends have now changed. The way dividends are treated for tax purposes has now changed. In the past, dividends came with a tax credit, and if you were a basic rate taxpayer, you didn't pay any additional tax on a dividend. If you were a higher rate taxpayer, you paid tax, but there was always a tax credit attached, and they were really quite tax efficient. A lot of you will use this in your tax planning, where you take a minimum salary, a larger dividend, and it's been very tax efficient for you. For the current year, from the 6th of April 2016, that's all changed. £5,000 of dividend income is tax-free. Dividends don't have tax credits attached to them, and there are now new rates of dividend tax of 7.5%, 32.5%, and 38.1%, depending on whether you're a basic 20% taxpayer, a higher 32% tax rate, or an additional 45% taxpayer. So 20% pays 7.5%, 40% pays 32.5%, 45% pays 31.5%. Dividends will be more expensive than they have been in the past. They won't be as tax efficient as they have been. If you've used the dividend trick in the past, you will end up having a bigger tax bill. It's still worth doing dividends. They still work as a tax efficient way of getting money out. Third thing I want to talk about in this section, the annual investment allowance. If you've got a lot of capital expenditure and you want tax relief on it, the annual investment allowance has been very, very useful. You can go out and spend up to £200,000 in the current tax year on capital equipment, excluding cars, by the way. But you can spend £200,000 on capital equipment and get 100% tax relief in the year in question. That figure has varied over the last half a dozen years, between £25,000 and £500,000. It's currently £200,000. It's an extremely useful relief, and getting the timing right on the purchases of your equipment is very important, because you don't want to exceed the 200,000 in one year and then waste some of the 200,000 in the following. Timing of your capital purchases is very important. Let's skip that one time. I want to talk about two things at the end. I want to talk about this as one. Good news to end up with. It's possible now to have £300 tax-free each year. Trivial benefits. If you buy a non-cash voucher, give it to your staff, £300 or less during a tax year, you don't have to pay tax on it, and you don't need to tell HM Revenue and Customs. One of my members of staff is my good lady wife. I give her vouchers round at the butchers, £50 a go, 6 times a year, £50 6 times a year, £300 a year. She can buy whatever meat she likes in the butchers. It's tax-free for her. It's tax deductible for me. We get the meat out of the business. Brilliant little £300 tax-free. And finally, I want to talk about digital tax accounts. Some of you will have heard of this. Some of you won't have heard of this. If I said to you, how about we abolish doing tax returns and never do another tax return again, you might think that was a good idea. Well, I'm telling you, it's coming. The government has started this thing called digital tax accounts, and it's going to spell the end of annual self-assessment tax returns and possibly payments that we're used to making in January and July each year, and it's going to spell the end of annual accounts, which means I'll probably be out of a job, except I probably won't be, because what you'll have to do is update your information on a quarterly basis. You'll have to tell HMRC on their website what your income is on a quarterly basis. Your tax information will be updated real time, or at least quarterly. If you're an employee, because we've got RTI where the HM Revenue and Customs are told what salaries are on a month-by-month basis, they can tell you on your digital tax account how much you've earned this year and how much tax you owe so far this year. If you've got a buy-to-let property, you'll upload the information on your buy-to-let property on a quarterly basis, and the tax system will calculate your tax liability on a quarterly basis. You'll be able to log on night or day, any point of the year, and work out what your tax liability is so far this year. You'll have the opportunity to pay your tax throughout the year based on the real-time information available. And it will show a complete picture of all of your taxes. So if you're got VAT, PAYE, corporation tax, income tax, all these taxes will be shown in one place, and you'll have an opportunity to pay your taxes off as you go along. If this all sounds a little bit far-fetched and a little bit futuristic, I can tell you that a lot of people have got digital tax accounts already. Anyone who's not VAT registered because they're under the threshold, by the time you get to the 5th of April 2018, you'll have one of these. It will be real. VAT registered businesses by 5th of April 2019, companies by 1st of April 2020. By 2020, we're all going to be doing digital tax accounts. It'll probably spell the end of annual accounting, because you'll be doing your tax return day by day as you go along. And that takes a little bit of thinking about, because sometimes as an accountant, I might write to my clients and say, it's time we got on with your accounts. Your accounts are due at Companies House in a little while. Your tax return is due at HM Revenue and Customs in a little while. And typically clients say, yeah, I'll get round to that. And by about September, October, November, 6 or 7 or 8 months after I've asked them, they hand in the information. That's a big leap from doing that to filling in your tax return real time once every 3 months. So good news, abolition of tax returns. Bad news, you're going to have to work a whole lot harder and a whole lot quicker. That is the end of what I want to say. That's who I am. That's where you can find me. If you have any questions, I am happy to answer them. I've had one from Mark. Happy to take them from anybody else. Any of you find that you've got another question and are too shy, embarrassed, it's too tricky, whatever, track me down and I will answer it. Otherwise, that's finished. That either means you've all dozed off, or it means that it was okay. But thank you, David. Thank you, Mark. Thank you, people. Thank you for listening in. It's quite strange doing one of these because I can't see you, so I can't judge whether you're dozing off or wandered away or whatever it is. But thank you anyway. Thanks very much. Okay. Thank you, people. Bye. Have a good day.